Hey guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So we're gonna go ahead and give you a mortgage rate update for 22-22. We're also gonna talk about where we're at on investor purchases. We're also gonna talk about the 10-year treasury and any historical data that we might have that correlates with what we are projected to go to and exactly the craziness that we have, which is called interest rates. So we're going to go ahead and price out 5 different mortgaging products. The first one is going to be a 30-year fixed, a 15-year fixed, a 30-year FHA, a 30-year jumbo, and a 5/1 adjustable rate mortgage. And if you don't know what a 5/1 adjustable rate mortgage is by now, it's just a 5-year interest-only fixed term and adjust every year after that, after the 5 years have concluded, according to the cap on your product. So we're currently on a 30-year fix sitting at 5.39%, increased rate by 0.01%. 0.24% increase from 1 week ago, 0.67% increase from 1 month ago, 2.25% increase from a year ago. 15-year fix will be at 4.82%, which is 0.03% increase from 1 day ago, 0.37% increase from 1 week ago, 0.74% increase from 1 month ago, and 2.22% increase from 1 year ago. 30-year FHA is actually going to be sitting at 5%, which is no change from yesterday, 0.25%. 0.25% increase from 1 week ago, 0.62% increase from 1 month ago, and 2.38% increase from 1 year ago. 30-year jumbo will be sitting at 4.62%. That is 0.03% increase from 1 day ago, 0.27% increase from 1 week ago, 0.52% increase from 1 month ago, and 1.37% increase from 1 year ago. 5/1 adjustable rate mortgage will be sitting at 4.30. That is 0.05% increase from yesterday, 0.28% increase from 1 week ago, 0.45% increase from 1 month ago, and 1.80% increase from 1 year ago. So that is going to be our mortgage rate update. Now, including with this mortgage rate update, a lot of huge investors really take a hold of, leveraging their money into real estate, right? So they go ahead and call us and we go ahead and get them in, and then we have a bunch of investor type of loans, investment loans called DSCR loans, which is a debt service covered ratio loan, which a lot of people who invest into real estate use this because you don't need an income, you don't need anything. The only thing you need to do is to make sure that the rental income for that property is going to produce enough to cover the debt on the property. That's why it's called the debt service. So the debt and then what is servicing it. Covered ratio. What is the ratio of that? So if you are curious about you're curious exactly how that works. If your rents are $2,000 a month and your principal, interest, taxes, and insurance is $2,000 a month, that is called a 1-to-1 covered ratio, and that is approved by most people. You can go a little lower than that, but it's harder. It's usually for more experienced investors, but majority of you are a first-time investor. We do mortgage products like that. Typically like to stay between the 1.1 and 1.25 range on their debt service cover ratio. And you could kind of do the math on yours and see what's going on with that. But as home sales have surged and prices have soared, real estate investors were no small part in the mix because real estate investors were a big chunk of it, okay? So the CoreLogic is this analytics company, and they also do credit and all this other stuff, says that home share sales going to investors, large and small, climbed steadily during the pandemic, rising from 14% in the spring of 2020 to 26.9% in late October or last October. So 26.9%, almost 27% of all homes purchased actually were purchased by investors. Let that sink in. Does that kind of correlate with exactly why why home prices have increased so much? Is because investors, they've kind of taken advantage of it, and so are first-time home buyers and people who are trying to buy. Millennials are a big part of it. So between millennials and investors, they've taken a big chunk of this. Moore says that after accounting for the largest share of home sale transaction in CoreLogic's record in October, the investor portion slipped the following month for the first time since July 2020. It wasn't a big decline, but by 1.5%. But in hindsight, 1.5% is a pretty big chunk of change, especially when you're going from 14% all the way up to 26.9%. Now the big question is going to be, is the investor spree still going on? Now firsthand, I'll tell you that most of my investors are kind of pumping the brakes because they don't want to go ahead and lose Now, for personal experience, where I'm at, you know, we have boots on the ground, you know, the frontline soldiers here. Now, I know as far as my investors go, my investors are kind of pumping the brakes. They're kind of, you know, waiting it out, because the worst thing that you could do as an investor is to kind of not to put yourself in a financially really bad position, because even though you're trying to build up your portfolio and you're trying to get to that large investor, because to be a large investor, you would need at least 100 properties and or above, right? Lower medium size would be between 50 and let's say 50 to 199, I guess, and then anything below 50 is going to be your smaller investor. So whenever you get to the higher investor, whenever you get to that 100 unit mark, then you become a little bit more less of a liability, and funds are so much easier to get, and everything becomes so much easier. So if you are an investor, just go ahead and make sure that your goal in life is to get to that 100 mark. Even if you get to the 50 mark, the 50 unit mark, you're still going to be pretty good about it. But as far as investors go, investor purchases were down in all three tiers. There are purchases in the top, middle, and third sales. Prices in their respective metropolitan areas declined by 6 points during or between October and December of last year. That accounted for 19% of the transaction in the bottom tier of the 5% drop. Now, investors and non-investors alike, I think it's everybody kind of just like, you know, holding their, just kind of like biting their tongue on, or like, you know, just not pulling the trigger on wanting to purchase a property right now, or trying to, like, you know, put too much skin in the game anymore, because the world of uncertainty is actually real. Now, as far as the interest rates go, this is kind of one of those historical facts that we don't, there's nothing that correlates one with the other. Now, as far as the 10-year treasury yield goes, I'll go ahead and put that up right now. It's almost equivalent to what it was pre-pandemic levels, which was back in, you know, 2018, 2019, where we're at 2.90%, which, you know, is hovering right around the 30% mark. But the total cost, it doesn't correlate, because the interest rate that was back in 2018, 2019 is not at the rate that it was before. So I'm going to go ahead and put this other little data sheet up there. This gives you the whole historical 30-year mortgages back from the 70s till today. Now, as you can see, most of the graph in itself, it shows you everything from 70. So what we had is in the late 70s, early 80s, and most of you guys remember, we had a little bit of a war. It was called the Vietnam War, and it kind of went through. This was the ending of it, and this was the correction of it. So we had interest rates that spiked up all the way up to 18, 19, even in some cases 20%. Depending on who was actually selling the mortgage. And then we had a complete steady decline after that, because at that very moment we were trying to go ahead and counter hyperinflation, which, if you haven't heard, if you haven't opened up your laptop, if you haven't turned on your TV or anything like that, and I guess that's why would you be watching this video if you haven't. But hyperinflation is one of those things that is in conversation right now, in which we are countering. Now, could this possibly be the route that we're taking, that drastic of a spike? And if that spike is going to happen, where would we be at? Now, I initially said that we are going to be in the sixes. That's where I assumed that we might be. Now, I am not quite sure. Is this something that we're going to go ahead and get completely screwed on after this? Because I'm going to tell you right now, and it doesn't take a rocket scientist to go ahead and understand this. If we go into the 7 or 8s, if we do, there will be a catastrophic real estate price drop that we have not seen. Because it's not the fact that we cannot, like, people will stop buying. People can't afford to buy it at that rate. Unless you go ahead and increase salaries by 40-50% across the board. If you increase salaries by that much, and all of a sudden people are doing more business and everything is, you know, triple and quadrupling in total revenue, then yeah, you could do that. But if we end up staying on the same track that we are, and if we do go into the 7, 8s, which we haven't been in the longest time. I mean, you could look at this, the last time that we were actually even close to that was almost 22 years ago. It's a long time, and home prices weren't the same that it is now. So this is kind of like a wait and see game, and kind of figure it out. But here's your mortgage rate update. Then up to 50% commission rebate on your next real estate purchase, any mortgaging assistance, or 0% listing on selling your current home. Link in the description below, and to stay up to date on mortgage rate updates, like, subscribe, comment, all that other good stuff. Until next video, guys, I appreciate you watching. Take it easy.